Hello, everyone. Welcome to our Safe Fab collaboration between Belen-Carrollton. We are lucky to have a wonderful panel here to discuss what is on everybody's mind around this time of year, and that is taxation. April 15th of every year, though maybe this year with a little bit of exception we'll talk about in a second, is when taxes are due. And there's a lot of questions to be had, especially in a different world we live in now. The way this event's going to go before panelists introduce themselves is we're going to have just a bit of a discussion here where the panel is really going to converse and discuss the stuff that's really top of mind that is going to really affect the financial status of our respective alumni. If you do have any questions, please feel free to drop them in the chat and we will ask them as part of our conversation. And that's really it. We're going to go here for as much substance as possible in as little time as possible. So hopefully you'll be getting a bit of an education throughout this hour. And without further ado, I will introduce Nelly to introduce herself first. Go ahead.
Hi, I'm Carrollton class of 2008. I am a tax attorney currently in Oxford, Mississippi, formerly Coral Gables, Florida, working for a Belen alum, Charlie Arizosa. I mostly work with international tax clients, but we also do a lot of domestic planning as well. And I'll introduce Frankie Damas.
Hi, everybody. Thank you for having me. My name is Frankie Damas. I went to Belen class of 2006. I am a tax senior director at Alvarez and Marcel Tax and out of our Brickell office. And I primarily work a lot within the business individual tax arena with a lot of background with it, partnership, pass-through, S-corp businesses. I worked a lot with a myriad of different industries, from private equity to manufacturing, restaurant, hospitality, and I'm looking forward to this event, broadcasting from my house currently. And I'll pass the mic over to Carlos.
Thanks, Frankie. Carlos Perez Aureo, Belen, class of 88. The managing partner at PL, which is a CPA firm in the Gables. We opened it about 21 years ago. It'll be 22 years in August. 60 people. They're in the Gables, full service audit, tax, consulting, and the like. Industry is pretty much what you see in Miami, small businesses. We don't do any public company work or anything like that. And that's about it on our end for those that don't already know about me. Juan, get back to you.
Thanks, everyone. So let's jump right into it. We had a lot of changes in the last couple of years, including just this March 11, when President Biden signed another COVID-19 relief package. This package had a lot of stuff inside of it that changed how our money works. So let's jump into the big media talking point, especially time-wise, considering a lot of people got them in their bank accounts this week. Let's talk a little bit about the stimulus payments. Frankie, what does the stimulus payment mean for the average person? Is this something that you're going to have to be paying back to the federal government at a later point? Or how do they work in practice?
So with this new act that was recently passed this past Friday, actually, there was, as many of you guys know, there was a third stimulus package that was released, and a lot of people have been wondering whether they are eligible for this new check. And there's been a lot of different changes with this new relief that are different from the last two, but ultimately it did piggyback a lot from what the old benefit packages that they had put together. One big thing here is this stimulus check is considered an advance tax credit that's an advance towards your 2021 taxes. The number is the $1,400 that a lot of people are probably familiar with. It is a refundable tax credit. So if understand that the IRS is working off of old data at the moment, so either 2018, 2019, or possibly your 2020 tax information if you guys are already ahead of the ball and have submitted your tax returns. But depending on your eligibility, the IRS is going to look at principally your 2019 tax info to see whether you qualify, and then they'll be rolling out those checks to taxpayers as quickly as possible. One of the big changes is that this $1,400 check is a per person, per dependent, type of recipient. So if you're a family of 4, husband and wife with 2 children, each one of you are going to get a $1,400 check, which is quite the boost from the previous packages. I think in the last round, there was only eligibility were children, and they had to be under 17 years old. So what Congress initiated here was they eliminated that threshold of having to only be children, and they included all children that are under 18 and any dependents as well. So it's that this is going to basically target a lot of Americans, and some Americans are actually going to miss out on this because of the steep phase out that they kind of implemented here. That there's been a lot of pushback on that as well, where essentially we're looking at AGIs where this is essentially your adjusted gross income, which for the most part is your all sources of income that you have, with the exception of some deductions that you get excluded from there. But you're looking at AGIs of $75,000 for single taxpayers, starts to get phased out. And then for married filing jointly, you're looking at it's about $150,000 of household income on there with the phase out. And so, and it's completely phased out once for married filing jointly, you get to $160,000. So there has been a lot of talk where if you had an extra $10,000, or let's just say you got a $10,000 bonus at the end of the year that basically just got you outside of the stimulus check eligibility, you are looking at potentially a marginal tax of over 100%, meaning you are paying more taxes than what you brought in from that incremental source of income. So it does create some funky scenarios, but Congress really did want to reduce the AGI threshold because they wanted to have this stimulus check a bit more targeted to individuals below a certain income threshold.
Speaking of income thresholds and congressional changes, this bill has, or this law, excuse me, also has a lot of child tax credits involved. You mentioned dependents earlier, and it also has a bit of a change to how those tax credits work. Can you walk us through a little bit how the kind of child tax going forward, how that's going to be changing? I believe in the summer. Please correct me if that's wrong.
Yeah, so another part of this tax relief bill on the child tax credit side, the child tax credit was expanded under the last tax reform, and it was originally $2,000 per child. And now with the new relief, they essentially boosted this for 2021 only, however. And that boost it's going from $2,000 to potentially $3,600. The $3,600 is eligible for children that are under 6 years old. So if you have any little rugrats that are 6 or older, that eligibility or the tax credit is capped out at $3,000. And so this is also a fully refundable credit for 2021 only. I don't believe for 2020 the full amount is refundable. I don't know if Carlos or Nelly can correct me on that one, but there's been a lot of nuances with this. And that credit does phase out in 2 different tranches. So the additional boost of $1,000 for and $1,600 for children ages 6 and under, that phases out at around just a gross income threshold of $150,000. And so, and then the original $2,000 child tax credit, that phases out based on the older rules, essentially going back to tax reform. And that threshold is a little higher, so it's at just a gross income of $400,000.
Frankie, excuse me, the $150,000, is that individual or household?
That's for joint filers.
Got it. And what is the twist here about having it potentially be $300 a month instead of a lump sum? Because that seems like quite the change.
Yeah. So another twist to this relief is that Congress was trying to get this money to taxpayers a little sooner, and it looks like they're trying to pave the path for expanding these child tax credits for future legislation. And one of these things is these child tax credits, even though they're 2021, they will be advanced payments where 50% of what you're essentially eligible for will be paid out starting, what I'm hearing is July of this year, all the way through December, and it'll be paid out in equal installments. And then the remaining 50%, you'll be able to claim it on your 2021 tax return when you prepare it, which will be in 2022. So they're trying to get this credit to the taxpayers a lot sooner, which is hence why they're doing this advanced payment plan. And I think they're also trying to set up an IRS portal for taxpayers to update their information as soon as possible with their adjusted gross income numbers, and if there's been any changes to the family where you've had additional children, or you've perhaps had some children move out of the nest because they've gotten too older and gone to college that are no longer eligible. So again, they are working off of the latest information that they'll have on file, which is most likely the 2019 tax returns.
Speaking of children leaving the nest, I know a question that a lot of our, especially younger alumni have, and a question that is really a big social question in the last few years is that of student loans, student loan debt, and student loan forgiveness. Nelly, can you please talk to us a little bit about what changes the relief package may have made regarding student loans? Will there be some forgiveness on the horizon? And if so, what are the tax implications of that?
So currently the administration has not canceled any loan debt, but the newest stimulus package, sorry, my dog.
It's okay. Student loans are a very exciting topic.
But the newest package, the American Rescue Plan, has made student loan forgiveness tax-free for borrowers through December 31st, 2025. So there's no income threshold to this. If you are in an income-driven repayment plan and you make your payments on time for 20 years, and those 20 years occur between now and 2025, usually the amount of the debt that was forgiven is includable as income, but this package said it's fine. It's completely tax-free. So you don't have to pay the IRS, which is great. But I mean, there's a possibility, there's a lot of talks on whether student loans will be forgiven. Biden ran on the $10,000 amount. I know Schumer wants 50,000, but those are all subject to income thresholds, which is like, if you make over, I don't know, like they were saying 150,000, I think, and that's, that excludes a lot of working professionals, so who have the bulk of student debt.
I know it's you touched on it a little bit. I know it's speculation at this point, but it does appear that changing those taxation rules on forgiveness would at least pave the way for it to be a possibility at some point during the Biden administration. Is that a correct assumption?
Yeah, there's been talks in the media about this, but I mean, this is just such a hotly contested topic, right? Like, I still have student loans, so I would love for them to be forgiven. But I know that a ton of people, who have paid in, how do they get to benefit from something like that? Will there be a windfall for them? So this is just not something that, like, I don't know that it would happen. And if it does, it's probably like for people who are making lower than a certain amount of income per year.
Sure. It does make sense, of course, that the band of eligible people, if it's going to be based on income, is going to be pretty small, considering the expected income of the average person with a bachelor's or a master's degree. So that makes all the sense in the world. Speaking of money coming from the government, Carlos, I think we're on PPP round 17, if I have heard the media reports correct. And based on that, it doesn't seem like anyone has any idea how the system works anymore. who's giving out the money, how much money is available, who qualifies at what time. Can you give us like a little bit of an understanding of what the environment is here, without spending the remainder of our period on just the PPPs?
I'll try my best, Juanqui, and yes, we probably would need additional time. We had actually had an Aves session last May when the PPP loan first came out, and there was a lot of questions as to what qualifies, what doesn't qualify, how do you get forgiveness, and we're almost a year later, and I think a lot of the same is still out there and open. Although I guess the first round of PPP, forgiveness has gone through in a lot of cases. We've gotten a couple of forgiveness, a couple of loans forgiven, so it was, I think, easier. The banks have changed a little bit, but some things that have changed recently, or since the last AVE meeting was, the initial loan period was going to be for 2 years, and after June 5th, they extended it to 5 years for any new loans, all accruing interest at 1%. If you got your loan before June of last year, you then have to get together with the bank to extend that period from 2 to 5 years if you are going to have to pay it back and it's not forgiven. Something that happened in the fall is that they did defer payments to be due, starting to, banks didn't have to start collecting payments until the SBA remits the forgiveness amount to the lender, back to the lender, or if you don't apply for it 10 months after the end of your covered period. So assuming an April or May of 2020 type loan, you're looking at a 24-week period of November, December, you have 10 months after that before you actually would have to pay something. PPP2, some changes, limits to 2 million. So the first round of the loans was $10 million. This one is $2 million. It is going to have the same 2.5 times your average monthly payroll costs for 2019 or 20. And then for those in the accommodation and food service sector, so they're targeting obviously the travel and restaurant business, but specifically the maximum loan amount is going to actually be 3.5 times your average payroll, up to $2 million. So they're giving them a little bit more, money up front. In terms of the expenses, they all pretty much stayed the same: payroll, rent, interest on mortgages, and then they added worker protective equipment, which was not in the first round of financing as an allowed expense. So any money that you're spending in your business to get protective equipment or to protect your people from working is also now going to be allowed. To qualify.
Real quick, feel free to continue after, but just about the protective equipment, are we looking at anything that you can call protective equipment, or is this for like a very specific list?
I don't have a specific list in front of me to answer that, but I would think that it's anything
Okay.
that you're buying to protect them. Obviously, you're going to start asking me, how about a laptop to take home because they're working from home instead of the office, and I don't know that specifically is going to qualify. But
this is maybe the first time of many times today where we do a disclaimer that this is not individualized advice, and et cetera, et cetera, et cetera.
So going back to the qualifications, you had to have received the PPP loan 1 and use the amount for authorized purposes. Employee count down to 300 from 500. And then the big one is that you have to demonstrate a 25% reduction in gross receipts between comparable quarters between 2020 and 2019. So you've got to do a look back in each fiscal quarter of 2020, compare it to that same quarter in 2019, and show that your gross receipts went down by 25% or more. And that's probably the biggest difference in terms of qualification. They also, I think, allowed 501c6 entities to apply for PPP 1 and 2 now, with this change that they made for PPP 2. Same covered period, 8 to 24 weeks, 60% has to be spent on payroll costs. And I already went over the other expenses. Now, something that's really important is that the IRS did, and they clarified it, I think, in this last bill, that you are going to be able to deduct the expenses paid with PPP loan money, and whenever it gets forgiven, it will not be included in taxable income. So it is, in essence, what a lot of people thought they were doing, but when the IRS first started coming out late last year, they were saying that no, that if you took the expenses, that they weren't going to allow you to take the expenses on income that was not taxable. But all that got clarified in December, and I think this last law or bill actually put it into law that they were going to be able to do that. A quirk there is states, right? So this is all federal legislation. And you've got to look at states. There are some states, Florida included, that is gonna not exclude the income from taxable income. So it's probably split 50-50. I was looking at a chart earlier today on that some states are treating them the same as the federal government, but some are actually making them whatever, somewhat taxable to that extent, because you got the money and they're not going to exclude the forgiveness part in income. So it's something definitely to look into as you start getting forgiveness and you have state tax issues. Obviously, Florida for the pass-throughs is not an issue, but for the C corps in Florida, it's something to look into, because it is going to be taxable income in Florida as we sit here today. Not sure that it'll change.
All right. But before we leave the PPP point, since Belen and Carrollton have such a we do cater to a very strong minority-based graduating classes, a lot of Hispanics, obviously, but minorities in general. There has been a lot of news about different criteria and different application timing, excuse me, not criteria, but different times when minority and or small businesses can apply for PPP loans. Is that still in effect? Did I hear the news wrong? Tell us a little bit about how the variance in PPP could be structured there.
I'm not there, Juanqui. You're gonna have to. Are you saying that the small businesses did not have access to applying for the loan?
No, I'm saying there was recently a period of where I know large corporations, I believe, were told to put on hold for a bit so that small businesses in particular could have access now, because I know there had been a problem with PPP loans going to small businesses and in some instances minority-backed businesses. Are there any future federal efforts in that regard, or is that something that was a one-time thing and we're just good to go from there?
As far as I know, it was a one-time thing. I don't know. I haven't heard anything recently about it. I think it's open. I think some, banks are still accepting. I think from for anybody, the biggest problem that happened in PPP1, I think, was access to the bank and being able to apply for the loan initially, which is what caused that, hold onto bigger businesses to allow smaller businesses to find a way to apply.
You mentioned the potential repayment and the tax status depending on the state. Another thing that the bill that just passed changed the tax status of was unemployment compensation. Can you talk a little bit about how the tax status is going forward after this law of money received through unemployment compensation?
Yes, absolutely. So one of the items was obviously with all the COVID relief, CARES Act, federal unemployment being extended for a period of time last year and now into this year through September, I believe, is what was there. Is the unknown fact, or the not unknown fact, but very underreported fact that unemployment compensation is taxable income, right? And they normally do not withhold on those payments from the unemployment division. So you get a 1099-G at the end of the year that says that you made $20,000 in unemployment and there's no federal tax withholding. So you now all of a sudden are in a tax burden. And I think that's what started the conversation in Congress. So what they came up with was that they're going to allow you to exclude up to $10,200 in unemployment benefits received during 2020, as long as your adjusted gross income is under 150. And that includes a spouse. So it's 10,200 for the husband and 10,200 for the wife if they were both unemployed and received unemployment benefits during 2020. However, you have to make less than 150, and they did not, for the first time that I've seen in a long time, identify what your filing status was. So it's 150 whether you're single, or 150 whether you're married, filing joint, or head of household. I have a feeling that that'll probably get clarified in the near future. If it's not, then it's just something that's a little bit weird, because most of the things that they do is definitely based on filing status. If you already filed your return, I'm not sure exactly how you're going to go back. You might have to amend it. I haven't really read up too much on that, but I know like our tax provider, our tax software provider, sent us an email that while they work out the kinks in how to get this into the software, to report it as another income, as additional income, and then to show it as an additional adjustment, as a reduction in income on the tax return in the different schedules on the 1040, until they figure out how to exclude that in their software.
So from jumping from unemployment, let's talk a little bit about incentives that were given to keep people employed. Frankie, I know that this was also part of the new bill and has been a focus on and off throughout the pandemic relief, both in the US and elsewhere. Obviously, we're not getting into international tax. I don't want to burden too much here. But tell us a little bit about the employee retention credit. What does it mean for those businesses that may be affected? How could it benefit them?
Yeah, so the employee retention credit, it didn't come through this last bill. It was essentially just extended from what was originally introduced in the CARES Act back in March of last year. And what it essentially did was just expanded this credit altogether. And we've been working with a lot of our clients in identifying a lot of opportunities. This is essentially a big cash grab for a lot of potential taxpayers who have experienced a revenue dip in their business, or some partial suspension shutdown because of the lockdowns that were implemented from their local governments. And so the credit from this new bill, it was increased from 50% of qualified wages to 70% of qualified wages, with a $10,000 limit of qualified wages per employee per quarter. So essentially what you can look at here is a potential a tax credit which is refundable towards your payroll tax credits. It's $7,000 per quarter per employee. So you can essentially get $28,000 of tax credits per employee for the year, for a full year, if you're eligible for those full 4 quarters. And so there's been a lot of talk in the beginning when this first rolled out as to what essentially are qualified wages, whether you should include healthcare expenses, health insurance expenses as part of that. And generally the answer is yes, you would use it, but originally the limit was originally capped at $10,000 of qualified wages for altogether. And so this has been a huge expansion, which a lot of clients and a lot of companies have been able to take advantage of. And so I've been working closely with our tax incentive group on identifying some of these opportunities, and it has been extended through the end of the year. So the Consolidated Appropriations Act that was passed in December had extended this through July, and now it has since been extended through December of 2021. And so in order for you guys to be eligible for this, you have to have met either one, the business was either fully or partially suspended by a government order, or two, the receipts for the quarter dropped by more than 20% when you compare it to the previous quarter in 2019. So the threshold in 2020, the reduction in gross receipts was actually 50,000. So it was a lot, 50%. So it was a lot greater. Now they reduced that percentage drop to 20%. And talking about the PPP loans that Carlos had mentioned, originally under the CARES Act, it was one or the other. You can either go to the PPP loan route or you can go the employee retention credit route. You couldn't double dip in essence. And so with the new acts that have been passed since then, Congress has allowed us to retroactively go back and now allow taxpayers who would otherwise be eligible for the employee retention credit also take advantage of that. However, there's a small caveat with that you wouldn't be able to use the same wages that you use to pay for your PPP loan that will ultimately get forgiven down the road. So again, they're trying to minimize this double dip abuse for taxpayers. So it's just something to keep in mind that whatever wages you use to pay with the PPP loan that it ultimately will get forgiven, you cannot use those same wages in terms of calculating your employee retention credit. There's still some guidance pending as to the route someone would take in order to retroactively try to amend perhaps your payroll tax returns for 2020. But ultimately for 2021, if you have seen a 20% reduction in gross receipts in Q1 through March of 2021, and you compare it to your Q1 of 2019, and there's still a reduction, you are eligible for this employee retention credit. And I strongly encourage taxpayers that feel like they fall within this category to work closely with their payroll tax provider and their CPA to ensure that they're getting as much benefit as they possibly can.
Before we move on to other topics, since there have been, like I think all three of you at different points mentioned multiple pandemic relief bills. Is there anything about this particular bill that just passed that you think will have a permanent change that people will have to focus on going forward, or are all of the deadlines going to come and go and not be renewed? And this could be for any of the panelists, as you please. Because I mean, from the way I'm looking at it, and this is my political background, maybe speaking here, but I've never met a government program that voters like and that expires on deadline. So are there going to be any of those that maybe the voters are particularly in favor of and that will stick around even though their deadlines may have been in the next couple years? I'm thinking here maybe the student loan forgiveness, or not forgiveness, the tax status, or maybe the family tax credit. Are those maybe here to stay?
I mean, I can take a first stab and kind of just, share my thoughts around this. Absolutely, I think that this has paved the way to what future legislation will eventually come about. It's important to understand too, like the political aspect of this and how things will ultimately get accomplished in Congress. And so one thing to really keep in mind is that this last relief bill was 100% partisan. This was passed 51-49, as slim as it can get, all Democratic support. And that means that they went through the reconciliation process, which they can only do once a year. All right. And usually, if you guys remember, where, a few years ago when Trump pushed through the tax reform, it was just a few years ago. It feels like it was so long ago with with so much that's been happening. But
4 times.
that was pushed through reconciliation by the Republicans. And so, I think a lot of people were expecting for the Democrats to do the same thing for tax reform 2.0, if you will. However, it's important to note that Congress runs under fiscal year. So I don't think we'll see new tax reform before October when their new fiscal year starts, but they'll definitely push through in October, November to try to get that out before the calendar year is over. I definitely expect that. And so I think with the student loans, they're definitely paving the way for something. And then as well as the child tax credit, I think there's a lot of bipartisan support in expanding the child tax credit. It was expanded under Trump's tax reform. So I think that they can probably get a lot of support from both sides of the aisles on that aspect. But, realistically, I definitely do see this as a partisan push as our government has gone more polarized over the years.
Yes, that seems to be the state of affairs in Washington. Carlos, Nelly, would you guys agree with that?
Yeah, I agree with that. There's obviously, I think that the employer retention credit, and there's certain credits that are going to obviously, I think, expire and not get renewed, the unemployment eventually, once everything corrects itself. But there also will be like the child tax credit and some others that we might see around for a while. But again, it's going to depend on who's in power in Congress and in the White House when they start, when they're due to sunset, which is what happens in a lot of these cases.
Of course. And of course, it's worth noting here that check back around the time of these deadlines, as our panel is saying, because they may or may not become political footballs when the deadline dates are fast approaching. Moving away from the COVID bills just a little bit, right? And taking a more broad perspective of how life has changed in the last year or so. One of the biggest changes has been folks moving and maybe not working and living in the state that they work in, or maybe being in the office versus not in the office. In fact, SAFE, one of the co-sponsors of this event, we actually were very lucky to gain 2 new board members who used to live in New York and now have moved down to Miami, and we are the better for it, and New York has the loss. So speaking of New York and Miami, Nelly, tell us a little bit about how this very strange, or maybe not, maybe it's a sign of how the world will work going forward. You tell us. Look into the crystal ball and please predict the future 100% accurately.
I hate doing that, yeah.
Well, you know what they say about predictions. Humans are terrible at predictions, especially when they're about the future.
Yeah.
But so tell us about that situation, right? What kind of circumstances is someone who worked in one state at the beginning of the year and maybe in a different state, or maybe lives in a state differently from where they work, give us a ballpark idea of what the tax situation looks like.
So typically in the before times, as you say, most states and state taxation, it's all based on nexus, right? So if, my dog again, of course, when I'm speaking, sorry. So whenever you generate income, you know, but that income is sourced from, you know, New York, but you're living in, you're a company in Florida, you have sales, you know, in New York, you have sales in Massachusetts, you have sales in Connecticut, you apportion, you know, your income based on where the revenue flows. Curiously, New York took the opposite position of this. In October of last year, the Department of Tax and Finance for New York released guidance saying that for non-residents with a primary office in New York, days telecommuting during the COVID-19 emergency will still be considered days worked in the state of New York, unless the New York employer created an office in the state where you know, its workers move to. So it's a case by case basis, you know, if you, I don't know, work for Google and Google doesn't have an office in Florida, and that's where you moved to during the pandemic, you're still going to be taxed as a New York tax resident on those W-2 wages, which is strange, but yeah. But thankfully, there's no income tax in Florida, so that particular person who moved from New York to Florida won't have to pay double tax, at least.
Well, at least there's that, right?
Yeah.
Speaking of working remotely, regardless of where that may be, as somebody who owns a small business, I'm very well acquainted with home offices from tax purposes. But there's a lot of employees who now have home offices, whether that be the kitchen table or whether that be a dedicated room. So Frankie, can you tell us a little bit about what the tax status is for that home office? Is a home office for an employee the same thing as the home office for someone who is self-employed?
So that is a very popular question in this current situation that we're all in with the pandemic, everybody working remotely, and it's a very good question to ask. And those that maybe not be up to date with the tax reform legislation changes that happened a few years ago, they currently suspended or eliminated a lot of the what they would call these portfolio deductions or 2% other deductions that we have on our tax return, sorry. And so short answer is employees are essentially out of luck when it comes to being able to take advantage of a home office deduction, but a lot of folks that are self-employed, and that can mean a lot of things, whether you're a partner in a partnership, you have an S corp where you're a shareholder, or you might have your own sole proprietorship where you're filing a lot of your stuff or filling it out on Schedule C of your 1040. Those who are self-employed do in fact are able to take advantage of this home office deduction, which during this pandemic is probably going to be greatly increased. I've heard a lot of rumors that potentially taking a home office deduction creates a red flag for potential audits down the road. Again, I can't tell you whether doing something will create more of a risk for being picked up for an audit examination. But a lot of people willingly will do the audit roulette if they feel comfortable with it.
Audit roulette does not sound like a very fun game to play. Seems like you can only lose.
I will say that the IRS is grossly underfunded at the moment based on the long wait lines on these calls. It's pretty impossible to get through to them during these days.
Is this something that we may, I mean, again, this is gross speculation, but is this something that was a temporary change, the one that was made a couple years ago to the difference versus employee or self-employed, or is this something that is perpetual? I.e., is there an expiration date?
I think it sunsets. I think at the end of 2025. It's a lot of, for those that are in, get into investing, a lot of investment expenses as well have been temporarily suspended for individuals. Corporations can still take advantage of them because these limitations don't apply to them. But currently, I think after 2025, a lot of these limitations will sunset and open the doors again. But we don't know what new legislation will roll out from today until end of the year.
Okay. So now we're going to take our very first question from the audience. I'm going to open up the floor to Nelissa so she can ask it in person. Well, in person.
In our new virtual reality. Yes, thank you so much for having us today and taking the time to explain these things that are very, very complicated. I am Nelisa Sati. I am a Carrollton alumni, class of 2005. I know Nellie and many of the other ladies here for quite some time. And I run a nonprofit organization called Superhero Leadership Academy, and we work with government, for-profit businesses, nonprofits, and educational institutions to teach low-income youth professional leadership skills. And the Miami Foundation, I'll copy-paste the actual, the Miami Foundation, when COVID originally happened, had provided many communications, but this one I thought was particularly interesting. Here, in terms of changes that occurred, I just pasted it into the chat, in terms of changes that had occurred via the CARES Act for charitable donations. So either personal or corporate contributions. I believe that this made it easier or provided incentives for either people or corporations or family foundations to be able to donate and get more incentives to be able to deduct more later on. But as you can see, this is very complicated and difficult to explain simply. So I would like your assistance, your expertise in this area, or your superpowers, particularly to explain how can we communicate this and what does this mean for clients of yours that would like to use charitable contributions as a way creatively, and how does it also apply to individuals that would perhaps like to start donating?
And let me jump in here real quick while our panelists are thinking and remind everyone that this is not individualized advice, and please consult your individual professionals for anything specific, individual, blah, 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 disclaimer. It looks like Carlos has unmuted, so.
I'll take a stab at some of it. So thank you for your question. And what a lot of this did was that there's always been limitations on how much of a charitable contribution compared to your income you can take as a deduction, both for corporations and or individuals. So what the CARES Act did, as you can see in your first line item, is that it suspended that 60% limit. So if you had adjusted gross income of $100,000, you could donate $60,000 and still deduct all of it. If you deducted 70, you would be stopped at 60, and you would have to carry over the 10. The new legislation lets you go up to $100,000 of your adjusted gross income, 100% of, I'm sorry, not 100,000, 100% of your adjusted gross income as a donation, and take that as a deduction. Similar with the corporation limit being at 10%, increased to 25% of income. Same concept there from that standpoint. You're not limited to a threshold where you can't deduct any more than that as a deduction. Interestingly, the $300 deduction is when you don't itemize. The tax change of 2017, the Tax Cut and Jobs Act, increased the standard deduction quite a bit to $12,400 or $12,200 per person. So it made it more difficult for people to itemize, and that was a big topic of conversation back then as to how it would affect charitable organizations. Because if a lot of people might say, if I don't get to itemize, because I don't get to, a married couple doesn't get the $25,000, $24,000 in itemized deductions, why am I going to give to charity? Again, you give the charity because you want to give to charity. I don't think that it's necessarily because of the tax situation, but for some people it is. So the CARES Act allows people that take the standard deduction to deduct up to $300 of charitable contributions, even if they do not itemize. And for this year, for 2021, I believe that number doubled to $600 from $300 as well.
Sorry, it cut off here. So I just added the other two parts as well. As you're going through it, it started for the deduction of the last two bullets. The last two are the I wanted to ask you, because does this mean that if you donate, for example, these specific funds by the Miami Foundation, there's more of an incentive for clients instead of directly donating to the nonprofit organization? If, for example, the Community Foundation, the Miami Foundation collecting all from these different donors, is it more advantageous for somebody who does have, for example, your clients, to be able to go and donate directly to the Miami Foundation instead of directly to the nonprofit?
I'm not sure here, deductions for gifts to response funds. Yes, so if they, I guess what they're saying is that if they donate to the Community Recovery Fund, they would qualify for that additional increase in the limit, right, is what they're saying.
Okay.
And
Thank
Carlos, that is another temporary change, correct? Not something we can anticipate going forward.
Yeah, right now it just says it was just for 2020. I don't know if the latest bill addressed this at all. I don't recall reading it, but I think it might have just been for 2020. I wouldn't be surprised that because of the pandemic still going on, that they allow it. Like I know that I know for sure the qualified charitable donation from 300 to 600 is something that's for this year, for 2021. I do not know about the limits, if they're going to leave them at the higher amounts or reduce them back to what they were pre-pandemic.
Sorry, quick clarification. When you say 2021, you mean for this year filing next, or for last year filing this?
This year filing next. So the 2020 is $300. The 2021 filing in 2022 is where I think they increase it to $600.
Cool.
And then regarding the donor advised fund, I think that's the last bullet point here, that it says it's not effective, but for those who aren't familiar with it, we're using it as a tax planning tool for those types of individuals that do not itemize, but have a lot of money and want to set up monies to give to charity. A lot of financial institutions are holding these donor advised funds, and you donate, $50,000 into this donor advised fund, and you get to take that deduction in the year of the contribution to the fund, and then you get to allocate on a yearly basis going forward those funds to different charities that you like. So it makes sense if you've got someone that's very philanthropic and wants to donate a lot of money over a certain amount of time. It might make sense for them to take advantage of a $50,000 donation in year one and then not do anything and just take the standard deductions in years 2, 3, and 4 as they utilize those contributions in the future. And any growth in that fund is also not taxed.
And the Miami Foundation is very equipped to handle that kind of across the board and provide the proper tax documentations to the donors, which is like an added incentive. For example, like George Perez individually has the George Perez Family Foundation, which has an arts big grant that is managed by the Miami Foundation as the community grant. So thank you so much. That made it so much more clear. Thank you.
No, I am glad that you got your question answered. That's why we have three so well equipped and qualified panelists. Speaking of, I want to bring the plane home here with a couple more topics. First, let's engage in some rampant and overt speculation that has potentially very little basis in reality. Just kidding. But from your specific financial perspectives, right? So let's leave the politics out of this completely. Let's leave the forecasting out of it. Looking specifically financially, let's see if we can try to look a little bit forward to the next couple of years under the current administration. So let's take it kind of a rapid fire. We'll start with Carlos. What could we see happen with the corporate rate in the next couple of years? Is it going to be going back up, staying the same, going down? What are we looking at?
That's a difficult question to answer without looking at the political spectrum.
Sure.
Sorry, I know I gotta talk financial, but
so let me keep it easy, right? Let's look at specifically the next 2 years where we know that it is a slim Democratic majority in both chambers in Congress, the slimmest possible in the Senate, and a Democratic White House with a phone call and a pen, as the previous Democratic president put it. So in the next 2 years, pre-midterms, corporate tax rate, do you think there'll be some movement?
He's going to try. Biden's going to try. He's made it pretty clear that that's his next step. He got this bill passed, and then like Frankie said, October you're going to hear it. All his tax wishes, and luckily I think he's got a slim majority in the Senate, and I think it's going to. If he's asking for 28% is what I'm reading on the corporate tax rate, maybe he ends up somewhere in the middle and doesn't go as high as the 28%. But yeah, I think if he gets what he wants, he's going to go up there, and he's going to go up as well on the individual tax rate on the higher earners to the extent that he can.
So
Look at, like, he's proposing 39.6 on the top level rate. Nothing on the bottom ones, just on the ones over the 523,000 single and 628 married family.
is that a very large percentage of the tax base?
No.
And
something that's interesting too, and I'm sorry to look at this that I hadn't read about, but I did read about it here, is that one of the things he wants to also do is Social Security tax, and start taxing Social Security after $400,000. So as everybody knows, they pay payroll taxes up to $142,800, 6.2 for Social Security, 1.45 for Medicare. The 1.45 for Medicare continues on forever. It no longer is capped out. But the 6.2 is capped out at 142.8. One of Biden's current proposals is to then start taxing you again if you make over $400,000 in wages. So the 142 to 400 will be exempt, but then over 400, they'll start again at 6.2%, which is 6.2 for you, and then I would imagine they're going to do it for the employer too, possibly. So it's 6.2 for the employer additional cost, which could affect a lot of people.
And I would imagine that for sole proprietorships and pass-throughs, et cetera, that would be also the same case with the self-employment tax.
If it's considered self-employment income, yes.
Okay. Before we jump on to the next topic, for anybody who's interested in the political ramifications of this, I suggest you read up on the Lord Regent from West Virginia, Joe Manchin, who is the most powerful person in Washington right now. So get acquainted with whatever he thinks the tax changes should be. Frankie, tell us a little bit about capital gains. What are we looking at here? And I will ask, because I'm required to do this, being a safe event, also include GameStop and money from any sort of Reddit bets in your explanation.
Well, market's been pretty volatile these last couple days, but yeah, I mean, to what Carlos mentioned, Biden campaigned heavily on targeting more taxes to those that are making more than $400,000 a year. He also was pushing hard on raising the capital gains rate and the qualified dividends rate to potentially 39.6 for those that are making $1 million. Now, us CPAs and attorneys, when we talk about numbers of income threshold, we speak in taxable income, AGI. Like, what exactly does that mean? Is it household income or is it per person? I'm thinking that the $400,000 number is probably a household income that he has in mind. A lot of people might think that it's maybe $400,000 per person. We don't know. I think it's intentionally vague, the way it's been laid out. But essentially, what he's been campaigning is, I think the capital gains rate, which for those that are aware, our individual ordinary income rates, the marginal rate is 37%. Capital gains, marginal tax rate is 20%. And it's been like that for a long time. And a lot of people have been attacking the capital gains rate since it came about, I think shortly after the income tax code was created. And what I would say is we have also very wealthy Democrats as well. So I don't know if that will ultimately find its way in the tax reform, but it is 2021 and nothing surprises me anymore. So we'll see how things come about. But I've had discussions with clients that are either in real estate that are looking to sell property, whether they can defer those gains or if they're looking to sell their business. There has been a lot of activity in M&A where people are trying to sell now in the event that these capital gain rates do climb up under a Biden administration. So it is something that is somewhat worrisome to a lot of taxpayers that are going to come into a lot of money in the short term.
Okay. Is capital gains the tax that can differ percentage-wise depending on when you realize your gain?
Yeah, so that's a good point. There's short-term and long-term. And so if the incentive of holding something for at least a year, then you'll get into the more favorable capital gains rate. Whereas in the short term, like if you buy GameStop, you see that you had a 300% increase and you want to cash out now before the bubble breaks on that, that would be considered a short-term capital gain, which will be taxed at your ordinary income tax rates. So oftentimes when we're talking about capital gains, it's in the long-term effect. And there's also been a lot of attack on carried interest, which you often see in private equity, where they've already kind of attacked it under the Tax Cuts and Jobs Act, where they require a holding period of 3 years or more in order to kind of get that favorable capital gains rate. But a lot of people, what they don't seem to understand is when tax rates increase, that doesn't necessarily mean more tax revenue for the government, because there's a lot of tax planning, deferral, slows down, the economy in some ways. So there's different ways around tiptoeing around when certain events happen, so that to make sure that these events occur when the tax environment is a little bit more friendlier to others.
The hottest topic on Capitol Hill right now, at least from the financial perspective, seems to be the rise of cryptocurrency, and its rocket ship straight to the moon. So what is the tax status of cryptocurrency today, and how could that potentially change going forward depending on the let's say the growing interest in the field? Because of course cryptocurrency's interest seems to grow by the day. So how is it, if you have crypto right now, what does it look like on your taxes, and could that change in the next couple of years? To whichever of the three want to take that. I know it's a touchy subject.
Right. I mean, I'll take it, I guess, Frankie, if you're good where you're at. So crypto right now is being considered an investment. And if you're buying and selling a Bitcoin or crypto, you're expected to report it on your tax return Schedule D as either short-term or long-term capital gain. We have a client who received a letter from the IRS where one of the places he was trading crypto in reported to the IRS proceeds of $2 million and zero basis. So you could imagine what that tax notice looked like. Obviously, he had a basis in it, and we had to amend the return and file with basis. But that's basically where it stands today. I guess if eventually it becomes a dollar bill and a currency, then I don't know if you're going to be able to keep that same concept of taxing it. But if because the dollar is the dollar, right? If you have a dollar in your wallet today, it's usually a dollar tomorrow, but that's not what's happening with crypto. So I don't know what the future would hold in terms of crypto, if it continues to become more mainstream.
So that was my next follow-up question quickly. Is it currently very different from other currencies from a tax perspective? And we're looking at something just whether or not it actually gets used as currency going forward?
No, I mean, if you're trading currencies, you're in the same boat in terms of gains and losses if you're actually buying and or selling them.
Okay. And then I have a note here. I'm going to ask this to Frankie, and I'm just going to read the note because I don't know what it means. Removal of 1031 exchanges.
Yeah, so those that are in the real estate industry, they're probably familiar with 1031 exchanges. This is something that if you own an investment property, you sell it at a gain, let's just say it's at $100,000 gain, as long as you reinvest those funds, meaning certain requirements, you reinvest those funds into a new property, you're essentially allowed to defer that gain, kick it out, further along until you subsequently sell that new property and cash out. So it's allowing your investment to grow with appreciation, tax-free, kind of like a 401k or retirement account. Essentially, you could defer this as many times as you want. There's no limit to how many times you can implement the 1031 exchange. Before the Tax Cuts and Jobs Act, this 1031 exchange was not limited to real estate, but then they kind of reduced this essentially only to mean real property. And so again, those that are investing in real estate, it is a tax planning tool where you kind of want to defer gain into a later year. Although when you're looking at higher income tax rates in the near future, you got to be cognizant of like where you're deferring this gain too. So you kind of don't want to shoot yourself in the foot. You might want to take the hit now, depending on how things go. But again, we don't have a crystal ball, so we don't really know the future for certain. But this 1031 exchange has been been placed on the chopping block under the Biden tax plan, where I think he wants to remove it altogether, or perhaps only for those that are making more than $400,000 or in excess, which ultimately those are the individuals that you tend to implement this tax planning tool more often than not.
A quick question from the audience on 1031, is there talk of it being removed?
Yeah, so I think I had just mentioned that Biden, this was on Biden's tax plan. When you go to his website and he lays it out, he was talking about removing it. Again, I'm not sure if he was talking about removing it altogether or just for those individuals that are making more than $400,000 in excess. But again, those are typically the individuals that tend to implement that tax planning tool more often, because it's just, it requires a lot of administration. You have to get an intermediary involved, and there are costs associated with it, but obviously the tax benefits are there and it's worth it. It's just when you're dealing with a lot of capital, that's when you'll usually see it. I recently had a client deal with it with a very large sale, and so I think they're waiting to see whether they want to trigger that gain as things get a little bit closer, but they're going to have to wait a little bit longer because of Congress is not going to have anything done before October.
All righty, one more topic before we land this plane, and it is the natural endpoint. And it's also a great segue from tax planning as we move into trust and estate tax planning. So Nelly, give us a bit of a rundown here. How has the COVID world changed this structure? Is this something that we need to really alter the way we think of it, or this is your field, so the floor is yours.
Yes, death taxes. So estate taxes and the exemption have not been altered yet. However, on Biden's campaign website, he did talk about lowering the estate tax exemption from its current level, which is like almost $11.5 million, down to 3.5, I believe. Those are the 2009 threshold levels, like before. So that would mean that a lot more people would have to think about estate tax planning than currently do, because currently, it's only for couples. Estate taxes really only affect couples with more than $22 million in assets. And the rate is 40% on whatever is above those assets. Biden also considered raising the rate to 45%. So that's a significant change. The second change was the repeal of the step-up in basis. So this is the idea that, great grandma and great grandpa bought a house in the 1920s for $10,000, and they lived for a really long time and passed away, 100 years later. And now that property is worth $1 million and they gift it to their kids. Their kids would receive that property with a basis of the $1 million at fair market value when they receive the asset. If they if they repeal this step up in basis, then the children would receive the asset with the historical basis of the $10,000. So now, if you sell the house for fair market value, you have, a gain of $990,000 that you would have to pay tax on. So that would be a great revenue making machine, more so than I think lowering the estate tax exemption, because there are ways to get around that. This past year in December, and in this quarter, we've had a lot of clients gift or sell business assets like shares in their corporations to irrevocable trusts as a way to take that asset, lock in any potential appreciation within an irrevocable trust structure for their children. So, I mean, there's ways to get around that. There's not much to get around the step up and basis repeal.
I have read in the past that there is a lot of variation in activity in regard to estate planning and tax planning, dependent on who exactly is in the White House. Is this just some media speculation, or is this something that you actually do see?
I mean, well, Trump's Tax Cuts and Jobs Act was huge. That this is like, each individual getting $11.5 million of not only estate tax exemption, but gift lifetime transfers. That's the highest I've ever seen. And, he's a billionaire. So, yeah.
All righty. Well, thank you very much for that answer. Thank you to all three of our panelists, and also to our guests. Nalisa, great question. That will conclude, because I think if we keep asking questions, we'll be here for a very long time. There's a lot to go into. I mean, what was that? The most recent tax bill was a couple thousand pages. So we'll call it here. I dropped a link in the chat to a survey that I please ask you to fill out so that SAFE can get an idea of how you like the event, how we could create events that fit your needs going forward. And if you do happen to have a question that was not answered, you can feel free to drop it in that survey. And you will get, well, I'll see it at least, and I will try to pass it along to our panelists. If you would like to watch a recording of this session, won't be available in a few days. We'll be on YouTube. We'll send it out. And also from our perspective, SAFE will be holding an event, I believe April 22nd, but you'll see it via email. We will be talking about Bitcoin, cryptocurrency. We'll be doing it in relation to the tech space and the entrepreneurial space. The Belen Alumni Network has a surprisingly large number of people active in this space. We had a great event with Julian last month, and we're looking forward to having another one in April. So watch out for your email there. Carolyn or Nelly, would you guys like to maybe promote anything that Carrollton has going on anytime soon before we sign off?
Yeah, thanks, Wonky. For the Carrollton grads, it's our reunion this Saturday. It will be in person for 2 hours, but everyone will be masks. It will be very COVID friendly. It's going to be open. Even if it's not your year, it's my year. It's 06 and I guess 1. Everyone's more than welcome to come. So I would love to see everyone there.
Awesome. And with that, I will close the proceedings. Thank you very much for coming. Please fill out our survey and keep an eye on your email for more FAB and SAFE events. Have a great night.